I've been studying war and money for over 30 years, and I can tell you this, every single time a major war breaks out in the Middle East, something happens to silver, gold, and oil that most people never see coming. Right now, we are watching Iran move into a full escalation, and the numbers attached to that escalation should freeze you in place. Silver at $120, gold at $6,000, oil spiking to levels that would shatter the global economy. These are not fantasy numbers from a doom blogger. These are the projections coming from institutional desks that manage billions of dollars, the same desks that moved early in 2022 before Ukraine, the same ones that positioned before the 2008 collapse. What I'm about to show you is not opinion. It is the documented pattern of what happens when a petrodollar war goes hot in the Persian Gulf. And right now, every single signal I track is pointing in the same direction at the same time. Most people are watching the news and thinking this is just more noise. It is not noise. It is the loudest alarm the global financial system has sounded in decades. Subscribe to this channel right now because what I'm about to explain will change how you see money, war, and survival forever. Let me show you exactly what's happening. The mainstream financial media is telling you that gold is high because of inflation. They're telling you silver is rising because of industrial demand. They're telling you oil prices are moving because of OPEC decisions. All of that is technically true, but it is only 10% of the story. The other 90% is geopolitical. And the center of that story right now is Iran. Here's what most people don't understand about Iran and the global financial system. Iran sits on the Strait of Hormuz. That narrow strip of water just 21 miles wide at its tightest point carries 20% of all the world's oil. 1/5 of every barrel of oil that powers every factory, every car, every airplane on Earth passes through that strait. When Iran threatens to close it, the entire global economy holds its breath. Now here's what they're not telling you. Iran has been systematically building up its military capability for closing that strait for the past 8 years. They have anti-ship missiles positioned along the Iranian coastline. They have drone swarms that have already been tested in combat. They have submarine assets that Western intelligence says are far more capable than publicly acknowledged. This is not speculation. This is documented in U.S. Department of Defense budget justification documents that most people never read. The villain in this story is not Iran alone. The villain is a global financial architecture that was built on cheap oil from a stable Middle East. That architecture is now cracking. The institutions that built it, the central banks, the sovereign wealth funds, the major energy conglomerates, they know it is cracking, and they are quietly moving assets into hard money right now. Here's the number that should stop you cold. In the last 6 months, central banks around the world have bought more gold than in any 6-month period since 1967. Not since the gold standard ended. Not since the 1970s oil shock. Right now. Today. The people who manage the world's reserve assets are buying physical gold at a pace that is historically unprecedented. Do the math yourself. If you have savings in dollars and bonds in a money market account, and the institutions responsible for the dollar's stability are abandoning it for gold at a record pace, what does that tell you about what they expect to happen next? Let me be direct. They expect a shock, a currency shock, an oil shock, or a military escalation that creates both simultaneously. And the Iran situation is the most likely trigger. The current escalation follows a very specific pattern I've seen 3 times before. In 1979, when Iran seized the U.S. embassy, oil doubled in 18 months, and gold went from $200 to $800. In 2012, when sanctions tightened and Iran threatened the strait, oil jumped $40 a barrel in 60 days. In 2020, when the U.S. killed Qasem Soleimani, gold hit its first major spike toward $2,000. Each time the market underreacted at first. Each time the people who moved early made the gains. Each time the people who waited felt the pain. Now, before I continue, let me ask you something. Have you actually checked what percentage of your net worth is in hard assets right now? Do you know how much of your savings would survive a 40% oil spike combined with a dollar devaluation? If this is already making you rethink your strategy, hit that subscribe button right now, because what comes next is going to show you exactly why this matters more than you think. Most people keep their money in the same places their parents kept money. Savings accounts, stock portfolios, maybe a 401k. That system was designed for a world that no longer exists. It was designed for a world with a stable petrodollar, a compliant Middle East, and a U.S. military that could project power into the Persian Gulf at will. That world ended quietly, and most people have no idea. Let me walk you through the evidence, because I don't want you to take my word for this. I want you to see the numbers yourself and reach your own conclusion. The first data point is silver's industrial demand curve. Right now, silver is being consumed by the solar panel industry at a rate that has never happened before in history. Every single solar panel contains between 10 and 15 grams of silver. The world installed over 500 gigawatts of new solar capacity last year alone. Do the math. That is billions of grams of silver being permanently consumed, not recycled, not returned to the market. It is gone. It is in panels on rooftops and in fields around the world. At the same time, silver mine production has been flat for 5 years. Supply is tight. Demand is exploding. That alone would push silver higher. Now add a war in the Gulf and a dollar shock. That is how you get to $120 silver. The second data point is gold's role as a war reserve currency. Let me tell you about someone I know. Call him David. David is 58 years old. He spent 30 years as a logistics manager for a mid-sized manufacturing company in Ohio. He was careful with money his whole life. He had $400,000 in his 401k, mostly in broad index funds. He had a paid-off house. He thought he was safe. Then 2022 happened. The dollar surged. His bond allocation got crushed. The stock portion held okay, but the real punch came when his energy costs at work tripled. His company started cutting hours. He saw his income drop by 30% in 12 months. He came to me frustrated, asking why his diversified portfolio had not protected him. Here is what David had missed. Diversification inside the paper system does not protect you when the entire paper system is under stress. When oil spikes because of geopolitical events, the whole economy feels it, not just one sector. David had zero physical silver, zero gold, zero hard assets outside the financial system. He learned his lesson the expensive way. He has since repositioned, but he lost 2 years of opportunity. David's story is the story of tens of millions of Americans right now. They think they are diversified, they are not. The third data point is oil's structural vulnerability. The U.S. Strategic Petroleum Reserve is at its lowest level since 1983. This is public information from the Department of Energy. The reserve was drawn down aggressively in 2022 and has not been meaningfully refilled. That reserve was the shock absorber. Without it, any disruption to Gulf oil flows hits the U.S. economy with full force, with nothing to cushion the blow. The fourth data point is the dark market in gold. Here's what you need to understand about what's actually happening in global gold trading. A growing portion of gold transactions are now happening outside of Western exchanges. China, Russia, India, the Gulf states, they are buying and selling gold in ways that do not fully show up in COMEX or London Metal Exchange data. Market analysts who track physical delivery flows estimate the true gold price, the price the big players are actually paying for physical delivery, is already significantly above the paper spot price. When that spread between paper gold and physical gold becomes impossible to ignore, the official price will snap upward to close the gap. That snap could take gold to $6,000 very fast. Let me know in the comments if you've seen this pattern too. Are you noticing gold and silver selling out at local dealers in your area? Are you seeing premiums on physical coins getting wider? Because thousands of smart investors are connecting these dots right now. If you want to stay ahead of what's coming next, subscribe and turn on notifications. The next section gives you the action plan that most people will completely miss. Now let me explain the mechanism, because understanding why this happens is the key to knowing what to do, and I want to make this as clear as possible. Think of the global financial system like a very large, very old building. The foundation of that building is cheap oil. Everything is built on it. Low transport costs, low manufacturing costs, low food costs. When oil is cheap and stable, everything in the building feels solid. When oil becomes expensive and unstable, the whole building shakes. For 70 years, the United States maintained what was essentially a security guarantee for Middle Eastern oil. American aircraft carriers in the Gulf. American military bases surrounding Iran. American diplomacy managing the relationships between Saudi Arabia, Israel, and the Gulf states. That security guarantee kept oil cheap and kept the dollar strong because oil was priced in dollars. You need dollars to buy oil, so everyone needs dollars. So the dollar stays powerful. Here's what most people miss. That security guarantee is now being questioned in every major capital in the world. Not because America is weak, but because America's willingness to absorb the cost of that guarantee has limits. When Iran escalates, when its proxies fire missiles at U.S. bases, when drone attacks hit Saudi infrastructure, the cost of maintaining that guarantee goes up. At some point, the math changes. And here is where it gets interesting. China has been building a parallel oil pricing system, the petroyuan. China is now the world's largest oil importer. And China has been quietly negotiating with Gulf producers to price some of that oil in yuan instead of dollars. Saudi Arabia has already done limited yuan-priced oil deals. Russia sells its oil in rubles and yuan. Iran, cut off from the dollar system entirely, sells in alternative currencies. This is structural. This is not temporary. The dollar's grip on oil pricing is loosening, and every time there is a conflict in the Gulf, that loosening accelerates, because every conflict reminds Gulf producers that their security guarantee is uncertain and that they should not keep all their eggs in the dollar basket. Now, some people will tell you this shift will take decades and nothing will happen soon. I understand that argument, but here is the counter evidence. The shift is not linear. It builds slowly and then breaks fast. The same pattern happened with the British pound in 1944 to 1971. Everyone knew the pound was losing its reserve status. It still happened faster than anyone expected when it finally broke. Here is what major countries are doing right now. China added more gold to its official reserves in the past 2 years than in the previous decade. India passed legislation making it easier for its central bank to hold alternative reserve assets. Saudi Arabia's sovereign wealth fund has been diversifying out of U.S. treasuries at a pace that Bloomberg has documented in multiple reports. These are not small actors. These are the pillars of the current system quietly positioning for a different system. The geopolitical angle tightens this even further. Iran's decision-making is not random. It is calculated to test the limits of Western response at a time when Western attention and military resources are divided. Ukraine is still ongoing. Taiwan tensions are elevated. The U.S. defense budget is under political pressure. Iran's leadership reads these signals. When they see opportunity, they move. And right now, they see opportunity. Let me connect this to the bigger picture. When you add together the silver supply crunch, the gold dark market divergence, the strategic petroleum reserve depletion, the Petro-UN challenge, and an Iran escalation that closes even a portion of Strait of Hormuz traffic, you get a convergence of forces that historically produces a violent repricing of hard assets, all at once, very fast, without enough warning for most people to act. The institutions that understand this are already moving. The question is whether you move with them or watch from the sideline. We are at a critical turning point right now. Within the next 6 to 18 months, we are going to see either a direct military escalation involving Iran or a near miss that is so serious that it shocks markets regardless. If you are just finding this channel, you need to subscribe immediately. I have been tracking this pattern for over 3 decades, and what is coming is unmistakable. Hit that subscribe button and check the link in the description. The window for action is closing faster than most people realize. So what do you actually do? Let me give you the action plan. 5 specific steps that I believe give you the best chance of protecting and growing your wealth through what is coming. First, establish a physical silver position. Not paper silver, not silver ETFs. Physical silver. Coins, bars, something you can hold. Silver at current prices is still accessible to ordinary people in a way gold is not. You can buy meaningful amounts for a few $100s. The goal is to own at least 1 to 3 months of living expenses worth of physical silver. Why silver specifically? Because silver is both a monetary metal and an industrial metal. It benefits from both the financial crisis scenario and the energy transition scenario. It wins in multiple futures. Buy it from a reputable dealer, store it securely, and do not sell it when you see the first price spike. The first spike is just the beginning. Second, get exposure to gold, but do it right. If you can afford physical gold, that is the best option. If not, look at allocated gold accounts with vaults outside the banking system. There are reputable services that hold physical gold on your behalf in non-bank vaults in Switzerland, Singapore, or Canada. Why outside the banking system? Because in a genuine financial crisis, governments have historically restricted gold holdings. Keeping it outside the immediate reach of your domestic banking system gives you an extra layer of protection. Even a 5% allocation of your total assets to gold provides meaningful insurance. Third, reduce your exposure to long-duration bonds. If you have a significant portion of your savings in government bonds or bond funds, understand that bonds get destroyed by the combination of inflation and geopolitical shock that we are discussing. A war-driven oil spike is immediate inflation. Central banks cannot raise rates fast enough to stop it without collapsing the economy. You end up with inflation that eats the purchasing power of your bond holdings faster than the interest payments compensate. Shortening the duration of your fixed income exposure or moving some of it into inflation-linked instruments is not optional in this environment. It is necessary. Fourth, look at energy equity exposure carefully. When oil spikes, oil companies make extraordinary profits. A position in established dividend-paying energy companies provides a partial hedge against the oil shock scenario. I'm not saying put everything into energy stocks. I am saying that having zero energy exposure in your portfolio, while oil is the single most geopolitically vulnerable commodity on Earth, is a mistake. Even a modest allocation of 5 to 10% in diversified energy equities provides real protection if the Gulf scenario plays out. Fifth, and this is the one most people skip, build cash reserves in multiple forms. Have some physical cash at home. Have some savings in a currency other than your domestic currency if possible. Have an emergency fund that can cover 3 to 6 months of expenses without touching any investment account. This matters because in a rapid escalation scenario, your first problem is not returns. It is access. ATMs go offline. Bank websites crash. Credit card systems slow down. The people who got through the COVID financial panic in March 2020 best were the people who had cash on hand and did not need to sell anything at the worst moment. Do not skip this step because it sounds boring. What you must not do is wait for the mainstream news to confirm everything I've described. By the time it is on the front page of every newspaper, the opportunity window has closed. The people who profit from these shifts are the people who understand the mechanism before it becomes obvious. That is what this video is for. Now let me bring this home. The core truth of everything I have shown you today is simple. War in the Persian Gulf does not stay in the Persian Gulf. It travels through the price of oil into every product you buy, every dollar you hold, and every asset you own. Silver at $120 and gold at $6,000 are not extreme predictions. They are the logical output of a system under the kind of stress that is currently building. Think back to the hook I opened with. 30 years of studying this, 30 years of watching the same pattern repeat. The names change, the countries change, the specific trigger changes, but the underlying mechanism is always the same. Hard assets win when the paper system cracks, and the paper system cracks when energy security fails. David from Ohio was not a foolish man. He was a careful man who had been told his whole life that the paper system was safe. He paid the price for believing that story. You do not have to. The Iran escalation is not a maybe. It is an ongoing process that is already in motion. The silver supply crunch is not a forecast. It is a documented reality happening in real time. The gold dark market premium is not a conspiracy theory. It is a mathematical fact that shows up in delivery data if you know where to look. The strategic petroleum reserve depletion is public government data that anyone can verify. This is not speculation. This is documented fact assembled into a picture that most people cannot see because they are looking at each piece separately instead of seeing the whole. Subscribe to this channel. Share this video with someone who needs to understand what is happening, and check the link below for the complete framework. Most people will watch this, nod along, and do nothing. Do not be most people. The window is open right now. The people who understand what I just explained are positioning themselves today, this week, this month. Be one of them. The cost of being wrong and prepared is small. The cost of being right and unprepared is everything.